Hello traders, the title of this video is Wave Trading Education Part 8. If you have not watched Part 1 to Part 7, you may do so before watching this. Let's get started. Wave Trading Education Part 8. Today is the 9th of July 2013 and the time in London is 56 minutes past 6. We are looking at Pfizer, okay, Epic Papa Foxtrot Eco, okay, PFE on the quarterly chart. This is the stock that we are using for this wave education, okay, wave trading education. All right. So in this video, we're going to discuss how an investor can use the wave principle to make excellent investment decision. As an investor, using the wave principle, one must align the individual financial instrument wave analysis with the market itself, okay, in order to have a harmonious, okay, signals, okay. So if you want to buy a financial instrument, like you want to buy Pfizer for a long term, okay, you must align your wave count for Pfizer with the S&P 500. The S&P 500 represents the market. So somebody who is an investor must always pay attention to the market first. If you are option trader, willing to hold a stock for a long time using the wave principle, you must always, the first thing, always, okay, look at the S&P 500 first, apply the wave principle to the market first before applying the wave principle to the individual financial instrument. This is how an investor will use the wave principle to make a long-term or medium-term investment decisions. Okay, so we are looking at this, the Pfizer, okay, on the quarterly chart. I've drawn some vertical line on my chart to show trader what is happening here. We know that the wave cycle is formed of okay, the motive wave and the corrective wave. This is one Elliott wave cycle. When a cycle has ended, a new cycle may begin, all right? Or we may see another correction taking place, all right? So it's not because we see, okay, a motive wave plus a corrective wave that we will definitely have a new bullish cycle or a new bearish cycle, all right? We may see, okay, a complex correction, which means the price may form ABC, X, ABC, X, ABC, which is a kind of a double zigzag or even sometimes a triple zigzag. One of the common mistakes that Elliott wave traders are making is that they are assuming something or they are trying to impose the wave analysis on the market. So we see here the price went up, okay, you can see here, okay, from 1994 the price went up for Pfizer, difficult name to pronounce, and then it went down, okay, this is a corrective phase. So are we having a new cycle or are we going to have X followed by another ABC? No one knows, but all we know is that one cycle is completed. To avoid making a lot of mistakes when one is using the wave principle to make an investment decision, one must, okay, align the wave count, okay, with the market itself, which is the S&P 500. This is very, very important. This is a practical, okay, guidelines that traders must follow, that investors must follow. Investors, hedge funds, institutional banks, okay, that are making long-term decisions must always align the wave count with okay, the market itself. All right. I'm going to bring on. I have here some line which I'm going to color this one here. This is, you can see here. This is the year 1999. I'm speaking fast because I don't want the video to be too long. So I'm going to color this vertical line in blue. This is the starting point. Okay. In 1999, we can see that this stock Pfizer went down up to the year 2000. Okay, in 2000, I'm going to color it now, this line here, into red. Okay, pay attention to the different stages, okay, during this Elliott wave cycle. So we see the motive wave, price went up. Now this is the corrective wave all the way to 2009. So from we can say that from 1999 up to 2009, this stock Pfizer Epic PFE was in a corrective wave. Okay, so almost 10 years correction taking place here. One thing I need to say to investors that are using the Elliott wave principle, if you want to make a long-term decisions, using the wave principle, you must understand the wave cycle. You want to align, the individual financial cycle with the market cycle. I want to show you something very interesting, and I hope you'll learn something from me. Let's move on very fast because we don't want the video to be too long, I'm looking at the S&P 500 exactly again on the quarterly chart, You can see that I have again my vertical line here. The blue line here, this, black line here, this is 1999. You will notice that from 1999 to 2000, the S&P 500, which represents the market itself, was going up. All right, this is on a quarterly chart. Was going up, yes or no? Can you see it in this section here? All right, can you see on your chart from here to here? This is from 1999 to 2000. It was going up. Let's go back again and look at the Pufizia, TFE. All right, again on the quarterly chart, we can see that from 1999 to 2000, Pufizia was going down while the market was going up. All right. In normal condition, unless there is a fundamental reason for this stock to go down, generally speaking, stock like this will follow the market itself. Though sometimes we have a divergence, it will be better for an investor to align, his or her decision with the market itself. So the market was going up while this stock was going down. Look what's happened. Because the market was going. The market was going up and it was going down. All right. Now, from 2000 to 2000, let's say to 2001, from 2000 to 2001, 2000 to 2001, this stock was going up. But I can tell you that from 2000 to 2001, the S&P 500 was going down. So there is a kind of divergence taking place here, which happens sometime. But the market will always win. All right, so that's why it's so important to align, your wave counts on one financial instrument with the market itself if you are long-term investors. So you'll be wondering what's going on here. Why is it going down? Unless there's a specific reason relating to that stock, the stock may go down when the market is going up. All right, that's nothing wrong with that. But we, as a long-term investor, we want to buy and hold. We want to sell and hold. We must align our wave count from the financial instrument onto the market itself. So there was a kind of divergence between the stock and the market itself. As I told you, the market will always win. Let's go back again and look at the S&P 500. Remember that from 1999 to 2000, this stock was going down. From 2000 to 2001, it was going up, but finally it started going down. Look at the S&P 500. Well, you can see from 1999 it was going up, from 2000 to 2001 it was going down, while this Pufizia was going up during this session. But finally, Pufizia was following the market also and will start going down also. In this scenario from here, from 2001 to 2003, all right, Pufizia was in harmony with the market. The best approach for an investor is to make excellent decisions at a hotspot of the zone using the wave count from the market first, checking the wave count on the market first, and looking for stock that are aligned with the market itself. So for instance, if you know that the market is at the beginning of the third Elliott wave, you will look for financial instruments that are also at the beginning of the third Elliott wave. If you have noticed that the market has displayed, a running flat correction, and a running flat correction is completed for the S&P 500 itself, you will look also for stock that has displayed the same, running flat correction. On the other hand, if the S&P 500 has displayed ABC correction, which is a zigzag, you will look for financial instrument also that has displayed the zigzag pattern. On the other hand, if it is a triangle that the S&P 500 has displayed, you will also look for a financial instrument that has displayed the ABCDE, corrective way, which is what we call a triangle. All right. If it is a normal zigzag, you will look for financial instrument also that has displayed the same pattern. As you can see here, the S&P 500 was going up. the PFISIA was going down. The S&P 500 started going down. PFISIA was going up, but finally has complied with the market itself. So you see here from 1999, 2000, the market from 2003, the market was going down. Let's go back again and see what's happened with the PFISIA. Okay. So we can see that from 2000 up to 2003, okay, PFISIA went up first, but because the general market was going down, as soon as it hit the resistance level, it started following the market here up to 2003. From 2003, the market started going up. You can see here it was going up, all right, up to this point, but finally it started going down. There must be some specific fundamental reason why the professional continue to sell this stock, though the market itself started going up from 2003. There was a divergence, which means by checking the market first, the market was bullish, but fundamentally speaking, PFISIA was bearish, and the market continued to sell PFISIA while the market started going up. In 2009, the market itself has completed a pattern. Let's go back again. Look at this, 2009. You can see that PFISIA has changed direction here and start going up. At the same time, the S&P 500 also start going up. If you are an investor looking to buy stock and hold for long term, it's very important to align your wave count that you have discovered, okay, analyzing an individual financial instrument with the wave count that you have discovered analyzing the market itself. Let's go back again and pay attention to the S&P 500, which is the market. It does not matter whether you are living in Canada, in India, in Singapore, or wherever you are in America, in Europe, okay, the S&P 500 is the market, all right? So we can see that from 2009, okay, the S&P 500 has displayed A, B, C, which is a flat correction here. This is what we call a normal flat, A, B, C. The price was in fact consolidation, which is a flat, the regular flat, okay, A, B, C, all right. The price did not go below the A corrective wave, okay, the A corrective wave right here, and change the direction in 2009. Traded, we know also as an Elliott wave trader, we know that the minimum price move is free. So when we see the price move and start going down, start going down, 1, 2, 3. Here, if you start changing direction, we will be looking for opportunity to buy because the minimum price move is what? Free. All right. So here, if you receive a signal to buy as an investor, we will look for opportunity to buy. So we will say a motive wave followed by A, D, C. At this point in time, we will look for opportunity to buy if the fundamentals are sound. We remember that in 2009, the Federal Reserve started pumping money into the market, which means all this money that low interest rate, the money that the bank are getting at a low interest rate were invested in the stock market. As they were putting money back into the stock market, the market start going up. We will look for financial instruments that are following the same pattern that has completed a corrective wave pattern. So the S&P 500 had displayed ABC. Looking at the PFISIA itself, all right, we can see that the PFISIA also has displayed what we call, okay, an expanded, okay, a flat correction, an expanded normal flat correction. If I explain to traders, if I draw lines on this chart, because I don't want the video to be too long, that's why I'm speaking very fast, my apologies to traders. So we will call, if I remove some of my line, I move this one to the side, we'll call this A, corrective wave. We call this one B, corrective wave, that failed to exceed the high of the A. So we'll expect, okay, a flat correction. As the price going down, we do not assume anything. We do not know that we're going to have the ABC in 5 wave down. As you can see here, it was 5 wave down. You can see that the price acknowledge this support level first. This is what we are saying to Elliott wave traders. Do not get into a scientific mode. It's the wave principle is a guidelines to allow traders to make excellent decisions, but one should not force the wave principle on the market. Step by step, price will move down from one level to the next support level until the price find a valid support level. If the price changes direction, do not ignore it, okay? So we see here the price. So we have here an Elliott wave cycle, motive wave. This move from here to here can be divided into 5 waves. The motive wave is the first wave, second wave, third wave, fourth wave, and the fifth wave. The corrective phase in this case is ABC. This is the A corrective wave. This is the B corrective wave. If you like, we can color it very fast. You can understand that I don't want the video to be too long. All right. This is the B corrective wave, followed by C corrective wave that has been divided into ABC. This is an expanded, a flat correction, a normal expanded flat correction, bringing the price down into 5 waves. This expanded C corrective wave, which we call, is not an impulsive wave, though it has been divided into 5 waves. It's not, an impulsive wave. It's a corrective wave, all right? If you want to know more, you need to go to www.24ElliottWave to learn to master a practical wave trading strategy. All right. To summarize everything to traders and to avoid that the video is too long, all right, is traders investors that are using the wave principle to make a long-term investment decision must align, the wave count relating to the financial instrument to the wave count relating to the market itself. If the market has completed a corrective pattern and the financial instrument also has completed a corrective pattern, one will align the signal from the market to the financial instrument and manage the investment. The macroeconomic condition and the fundamental relating to each financial instrument can change the dynamics of the market at any point. It's not because we have counted wave or we have seen a wave pattern that the financial instrument will definitely go up or will definitely go down. After doing the technical verification, one can go to Google Finance, Yahoo Finance, Bloomberg, Financial Times, Forex Factory to investigate or verify or confirm, the technical signal with the fundamental signal. All right? It makes sense? It's also powerful. So we can see that PHYSIA here on this quarterly chart. We have a multi-wave, then we follow by 5 wave down. This is an expanded flat correction. In 2009, the market S&P 500, so PHYSIA was completing a corrective wave pattern, multi-wave followed by ABC, and expanded the flat correction, ending in 2009. We will check quickly the market, so we must first check the market. We notice that the S&P, in fact, also has completed ABC, which is a flat correction in 2009. At this point in time, we'll be watching the S&P 500. If the macroeconomic condition, if policy brought forward by the Fed align with the current market environment, if the market is about to go up, they start putting money. The bank are putting money back to the stock market. The S&P 500 start going up. We see that the PHYSIA also has displayed, has completed, a corrective, wave pattern. We will be happy, to buy also PHYSIA, provided that the fundamental relating to PHYSIA also is sound. If the fundamentals are not sound, the market may be going up and PHYSIA may be going down. As we have seen here, from 1999 to 2000, PHYSIA was going down while the market was going up. From 2000 to 2001, the market was going down, but PHYSIA was going up. So by aligning, the wave count from one financial instrument with the wave count on the market itself, investors can make excellent long-term investment. I hope you have enjoyed this video also about wave trading, education part 8, and we'll put into use to make excellent, wave trading decisions and investment. Until the next time, enjoy yourself and be very happy. We are the TSTW SYS008 traders. Speak to you soon.